Joining me now, Paul Baiocchi, Head of Fund Strategy at SS&C ALPS Advisors. Paul, thanks so much for joining us.
Thanks for having me, I'm excited.
So we're talking electrification. Electricity demand is expected to grow at rates not seen since the 1960s due to things like AI, of course, and reshoring, consumer trends. When you look at this trend, where do you see the biggest opportunities for investors?
Well, I think to level set, it's important to understand what's driving it, and it's largely AI data centers. People see it in the news, and then they think about consumer level trends, switching from ICEs to EVs. Then you touched upon policy, trying to bring back manufacturing capacity in the United States, some of the big deals, investments that have been announced as part of the trade deal framework, and understanding what's driving it then leads into the question about how you invest in it. Because importantly, what we believe is that you get a lot of exposure already in your core equity exposure to the companies that are driving rising electricity demand, whether it's NVIDIA or the hyperscalers who are investing in these massive data center projects. Whereas when you think about downstream, what the implications are of electrification, where are the companies that are going to benefit? And largely, we believe it's companies in various segments of the energy market. It's certainly utilities companies, because those are the ones tasked with providing that electricity at higher loads. And then you can get into the nuts and bolts, the picks and shovels, if you will, of the electrification infrastructure build out.
So I was taking a look at your fund, ELFY. It really spans multiple sectors and industries, but it focuses more on companies that benefit from the rising demand, not necessarily the ones that produce it. However, some of your biggest holdings, Sterling Infrastructure up more than 70% year to date, EMCOR up almost 40%, Generac, GE Vernova also posting impressive year-to-date gains. For those investors who are trying to think of entry points, is now still a good time to get in?
Well, we believe that this is a generational investment opportunity, a trend that's not going to play out over the next 18 months, but rather over the course of the next 10, 15, 20 years, or even more. And the reason we believe that is because you hit on it a little bit in terms of electricity demand growth, not seen since the 1960s. Well, to put some numbers behind it, FERC has put together some projections, and just as a baseline, we've grown electricity demand in the United States at about 0.4% annually over the course of the past couple of decades. FERC says a baseline expectation is 8% electricity demand growth over the course of the next decade plus. And then if you start to layer in data centers and increased EV adoption, 15+% growth in electricity demand. So with that growth in electricity demand comes a need for investment in the infrastructure, and we're starting to see numbers put behind this. Bloomberg NEF has forecasted $100 billion in annual investment in grid improvements in the coming years. And then you look at the Edison Electric Institute, which is projecting CapEx budgets for utilities. They spent about $1.5 trillion over the past 5 years in CapEx. They're expected to spend $1.1 trillion over the course of the next 5 years. So the investment's coming from a number of angles, and it's important to understand where that investment is going. And to your question about what is a good entry point, I think we were fortunate when we launched ELFY in April that the market was starting its bottoming process, and so we've benefited from the strong rally off of those bottoms. But some of these trends, copper demand, natural gas demand, potentially down the road, application of small modular reactors in the nuclear space, isn't going to just play out over one market cycle. It's going to play out over multiple cycles. And because most core equity allocations are oriented toward technology, which is 30% of the S&P 500, and hyperscalers, utilities, which is 40% of ELFY, aren't necessarily well represented in your typical asset allocation framework. And so ELFY is additive from a diversification perspective, but also importantly, unlike a lot of thematic portfolios, it's not just aiming for high flyers. The baseline of the portfolio being in utilities speaks to a defensive orientation in a sector that maybe is changing its stripes in terms of potential revenue growth and new compounding opportunities.
Do you use AI when trying to choose which companies you're going to invest in?
We don't. So Mark McLean, who is at Ladenburg Thalmann and was in utility finance for a long time, came up with the index. And it pulls from, as you said, 5 different sectors, 18 different sub-industries, minimum market cap of $5 billion. And the reason I bring that up isn't to promote the strategy as much as to give a sense of how this requires textured exposure. It requires a mosaic of strategies to capture this electrification theme. And ALPS is one piece of it, but you think about commodities portfolios that own and track the individual commodities themselves, whether it's copper, whether it's some of the base metals that are going to be critical to the grid infrastructure, or midstream energy infrastructure, which are the companies that own the pipelines that ensure the natural gas produced in the United States gets to the utilities, gets to the data centers to be hooked up to, as you mentioned it, a GE Vernova gas turbine to allow that data center to have access to reliable electricity.
So for someone interested in investing in the electrification trend, what is the most important thing they need to know before investing?
I think they need to know that it isn't going to be captured necessarily, at least completely, by your typical equity strategy that's cap weighted, whether it's an S&P 500, Russell 1000, because a lot of the companies in the electrification theme or that stand to benefit from the electrification theme aren't necessarily big weights in indexes at this moment. And so trying to reorient your portfolio to ensure that you get exposure to some of these companies before perhaps their market cap contribution to an index grows. And also to be creative and thoughtful and deliberate about how you go about allocating to it. Don't close yourself off in terms of the exposures that you use to get the electrification theme in a comprehensive way.
And just finally, any key risks they should be aware of?
Sure, I think the key risk is that we're ramping up to invest in all this new capacity, whether it's AI data center capacity or even utility capacity, electrification capacity, grid capacity. And there is always the risk of overinvestment. We saw it with that DeepSeek sell-off earlier in the year where there were concerns that maybe all of these projections, all of this CapEx budgeting that's been announced isn't going to be as necessary as maybe the market was anticipating because someone could do it cheaper and more efficiently. Well, that to us is the big downside risk in this space, as just like these hyperscalers are spending massive amounts, 85 billion, 90 billion, 100 billion in CapEx spending, if utilities companies, which are 40% of ALPS as a benchmark, overinvest in capacity and they aren't able to realize the profitability potential because electricity demand doesn't manifest in the way that's being projected, that could undermine the opportunity.
Okay, thank you so much for shedding some light on the space. I really
My pleasure.
appreciate it.
Thank you.
That's Paul Baiocchi, Head of Fund Strategy at SS&C ALPS Advisors.